What are the most common retirement accounts? Why should I invest in retirement if I'm only in my mid-20s or early 20s? And which accounts should I even invest in? These are the questions that I will be answering in today's episode of Makeup and Money, which is also the first episode of Makeup and Money. And if you haven't guessed, we are covering everything on retirement accounts. This is basically a space for me to get ready for the day and share everything I've learned around personal finance so that we can set ourselves up as best as possible for the future. If you're new here, I'm Carly. I'm 25. I've saved well into my six figures, and this is primarily through tax advantage retirement accounts, and also a little bit through regular brokerage accounts as well. I've learned a lot along the way, and I'm still learning, but I thought I would share what I know so far. Okay, hair's going back first. The first main reason why you should prioritize investing in a retirement account as compared to a regular brokerage account is the tax advantages. The most common benefits include contributing pre-tax money into these accounts, which basically means that you're lowering your taxable income for the year. And there's another tax advantage where you can also contribute post-tax money, and it grows tax-free for whenever you want to withdraw it at 59.5 generally. And I'll cover more tangible examples later on in this video when I cover the 401ks and IRAs. So when it comes to saving for retirement, you should start yesterday, unless you're 18, in which you can start today. And the reason for this is compound interest, where basically you're earning interest on the interest. For example, if you invest $100 and it grows at a 5% interest rate, after the first year, you'll have $105. After the second year, you'll have earned 5% interest on the $105, bringing you to $110.25. I'll give another example. So if person A and person B both start with $0 and they contribute $500 a month, but person A started at 20 years old and person B started at 30 years old. By the time they're 60, and assuming interest rates are at 8%, which has been the average annual returns of the S&P 500, person A by 60 will have $1,554,339.11. And person B will have $679,699.27. So starting 10 years later could mean half as much money, and that's the power of compounding interest. There's a very popular saying that time in the stock market is more important than timing the stock market, so figuring out when you should buy in. And this basically means that you invest your money in an exchange-traded fund and you just let it sit and don't look at it. So now that we know why you should invest in retirement accounts, let's move on to the most common types of retirement accounts. If you're employed by a company, which I suspect many of us are, your bread and butter will be the 401k. If you work a corporate job, they will most likely have a 401k program where you can contribute to a 401k, and sometimes they will even match a percentage of what you contribute. If they do match, it might look like the company contributing 50% of every dollar you contribute into your 401k, say up to 6% of your salary. You should do whatever you can to maximize this match because it's pretty much free money. So say I make $100k a year, 6% of my salary is $6,000. My company will contribute up to $6,000 into my 401k. And if they match 50% of every dollar I contribute, that means I would have to contribute $12,000 to get that match, essentially. Once you've reached the match, it's up to you to decide if it makes sense for you to continue investing in a 401k account. You might want to start contributing to a Roth IRA or even a regular brokerage account with no tax advantages. And the tax advantage of the 401k is that you're able to contribute pre-tax money into retirement. So basically, if your annual income is $100,000 and you contribute $12,000 of pre-tax money into your 401k, then your taxable income gets lowered to $88,000. And the money in your 401k account grows tax-free until you choose to withdraw it, which generally the age at which you can withdraw without penalties is 59.5. At that point, you'll have to pay income taxes when you withdraw it. So for all of the retirement accounts I will mention, you have to be 59.5 or older to start withdrawing the money. Otherwise, you'll most likely pay some sort of penalty. Your company may also offer a Roth 401k, and this is less common. It basically gives you the opportunity to contribute after-tax money into a 401k account. That basically means that you're taxed now and you don't have to pay taxes on the capital gains and dividends and growth when you withdraw it at 59.5. This is super similar to the Roth IRA, which I will also discuss in a second. As far as the traditional IRA, this is something that you can set up for yourself. It's very similar to a 401k in that you contribute pre-tax money into the traditional IRA. And the limit for 2023, I believe, is $6,500. I pretty much see traditional IRAs and traditional 401ks as the same thing, except the traditional 401k is sponsored by your employer, while the traditional IRA you open by yourself. With the Roth IRA account, you contribute post-tax money. That's the tax advantage. So when you contribute the money, you invest the money and you let it grow. When it's time for you to withdraw the money, you can withdraw it and not pay taxes on it at age 59 and a half. Roth IRAs and Roth 401ks are pretty much the same concept, but again, the Roth 401k is sponsored by the company, while the Roth IRA you open by yourself. For both the traditional and Roth IRAs, you can't set one up until you are 18 years old. But if you're a minor and you're making money, then your parents can set up a Roth or traditional IRA account for you. And that's what's called a custodial Roth IRA. People say if you think your income bracket will be higher at retirement versus now, you should contribute to a Roth IRA or Roth 401k. The idea is you'll be paying lower taxes now than later. Conversely, if you think your income bracket will be lower at retirement than it is now, so if you think you'll be making less money at 60 than you will be now, you should focus putting money in a traditional IRA or traditional 401k. Because for the traditional accounts, you pay taxes when you withdraw money, but your income will be theoretically lower than now. So you'll be overall paying less taxes. I used to be really confused about this because I used to think if you're retired at 60, don't you have no income basically? But then I realized, well, if you've built up businesses or built up streams of passive income, you could very well still be making money when you're 59 and a half, even if you aren't employed by a company. I'm 25 right now, and realistically it's kind of hard to tell what my income level will be many decades from now. So right now I'm focusing on contributing both to a traditional 401k and a Roth IRA. So kind of evening out. Later on when I'm 60, I'll probably use a CPA or whatnot to maximize my withdrawals so I can pay as little taxes as possible. I think it's also worth noting when you might not want to invest in retirement. So if you anticipate needing cash in the near future, this is in like the next 6 to 12 months, I would hold off. For example, if you have to pay off debt, high interest debt specifically, I would focus paying off that debt first and then start contributing to a retirement account after I've finished paying off my debt. If you're trying to achieve FIRE, so financial independence, retire early, this is basically a movement where you make as much money as possible and live well below your means to save as much money as possible so that you can retire when you're 35 or 40 or 45. You're probably going to want to focus a lot of your investments not only in retirement accounts, but also regular brokerage accounts as well. This is mainly because while retirement accounts do have tax advantages, you're really limited to how much you can withdraw before you reach the age of 59 and a half. So whatever money you put into your retirement account, you should pretty much not anticipate needing it until 59 and a half. Sometimes we come across situations we don't anticipate where we do need this money. So it is possible to withdraw money from a retirement account, but there may or may not be some penalties. If you need to withdraw funds from a retirement account, I would see this as a last resort, but you do have options. There's one option to take out a loan against your 401k. This is usually up to $50,000 or 50% of your account value. I think whichever is lower. You can do this on a tax-free basis, but basically you have to repay the money back into your 401k account as if no money was ever withdrawn. You can also withdraw money from a Roth IRA account before the age of 59 and a half. And generally you have to pay taxes on this, and you may be subject to a 10% early withdrawal penalty. I think there are some exceptions where you don't have to pay a penalty or potentially pay taxes either, like if you're buying your first home, or if your child has a disability, or if you birthed or adopted a child, something like that. So basically there are exceptions, but I would recommend looking at these with a financial advisor if you do need to withdraw money from your Roth IRA. And generally I would make withdrawing money from retirement accounts my last resort, because once you withdraw money, you miss out on the growth of the market. And in the case of a Roth IRA, you're not able to contribute the money back into the account, if I'm not mistaken. On top of that, you do have limits for how much you can contribute to the account. So if you do withdraw early, you're really stuck on how much growth your account can have over the long term. And once you've started funneling money into these accounts, it's up to you to decide how you want to invest. You can choose to invest a little bit more aggressively, like choosing specific stocks, or you can invest in index funds that basically track the performance of a pre-selected bucket of stocks. The most common ones include indices that track the S&P 500, that track some sort of total money market fund, maybe some international money markets. For me, I largely buy into these ETFs and then I leave it. That's pretty much it for today. I am more or less done with my makeup. It's pretty much my everyday look, a very natural look, and anytime I put on makeup, I pretty much just do this. That was my first episode of Makeup and Money. Let me know if you liked it. I'm trying something new with this, and maybe it's more beneficial to have this information just straight on as compared to me doing something. So I'm very open to feedback. Next week, I will be talking about credit cards, which I just decided right now, but click on this link to view. Bye.